In 1985, two struggling natural gas companies merged to form what would become known as America's seventh largest corporation, worth over $74 billion at its peak. Enron Corporation promised to revolutionize the energy industry through innovation and deregulation. For 16 years, it dazzled Wall Street analysts, politicians, and investors with meteoric growth, posting profits that seemed to defy economic gravity. The company's executives graced magazine covers as visionary leaders of the new economy. Fortune magazine named Enron America's most innovative company for 6 consecutive years from 1996 to 2001. But beneath the gleaming corporate facade lay one of the most sophisticated financial frauds in American history. When the house of cards finally collapsed in December 2001, it would destroy the retirement savings of 20,000 employees, wipe out billions in shareholder value, and send shockwaves through global markets that fundamentally changed how we regulate corporate America. The story begins with Kenneth, a former economics professor and government regulator who believed passionately in free market capitalism. In 1985, Lay engineered the merger between Houston Natural Gas and Internorth, creating Enron Corporation with himself as chairman and CEO. The company started as a traditional pipeline business, transporting natural gas across America through a network of 37,000 miles of pipes. But Lay had bigger ambitions. He envisioned Enron as an energy trading company that would profit not just from moving gas, but from buying and selling energy contracts like commodities. This required transforming Enron from a regulated utility into a financial trading house, a shift that would prove both revolutionary and catastrophic. The company's early years showed promise, with revenues growing from $9 billion in 1990 to over $13 billion by 1992. However, the traditional energy business operated on thin profit margins, typically earning just 2 to 3% on revenues. This reality didn't align with Lay's vision of explosive growth, setting the stage for increasingly aggressive accounting practices that would eventually consume the company. The architect of Enron's fraudulent transformation was Jeffrey Skilling, a brilliant Harvard MBA and former McKinsey consultant who joined the company in 1990. Skilling possessed an almost messianic belief in market forces and introduced what he called the gas bank concept, where Enron would act as an intermediary between gas producers and consumers, profiting from the spread between buying and selling prices. But Skilling's most dangerous innovation was convincing the Securities and Exchange Commission to allow Enron to use mark-to-market accounting for its trading business. This accounting method, typically reserved for securities trading, allowed Enron to book the entire projected profit from a long-term energy contract on the day it was signed, rather than recognizing revenue over the contract's actual lifespan. For example, if Enron signed a 10-year gas supply contract projected to generate $50 million in profit, they could immediately record that entire $50 million as current earnings, even though the actual cash wouldn't arrive for years or might never materialize at all. This accounting sleight of hand created an addiction to new deals, as Enron needed ever larger contracts to maintain the illusion of growth. By 1996, when Skilling became president and chief operating officer, mark-to-market accounting had transformed Enron's financial statements into elaborate works of fiction. The fraud accelerated dramatically with the creation of special purpose entities, or SPEs, designed by Enron's chief financial officer, Andrew Fastow. These off-balance sheet partnerships had legitimate uses in corporate finance, but Fastow weaponized them to hide Enron's mounting debts and inflate its profits. The most notorious were the LJM partnerships, named after Fastow's wife and children, which he personally managed while serving as Enron's CFO. Through these entities, Enron would sell assets to partnerships controlled by its own executives, immediately booking profits while keeping the associated debt invisible to investors and regulators. In one typical transaction, Enron sold a power plant to an LJM partnership for more than its book value, instantly generating millions in reported profits. However, Enron guaranteed the partnership's debt and promised to buy back the asset if it declined in value, meaning the company retained all the risk while claiming none of the liability. Fastow earned over $45 million personally from these partnerships between 1999 and 2001, representing a massive conflict of interest that Enron's board inexplicably approved. By 2001, Enron had created over 3,000 SPEs, many with names like Jedi, Chuko, and Raptor, that reflected the fantasy nature of their financial engineering. The human cost of Enron's culture extended far beyond accounting fraud into the systematic exploitation of employees and consumers. Skilling implemented a brutal performance review system called Rank and Yank, where employees were rated on a curve and the bottom 15% were automatically fired regardless of their actual performance. This created a ruthless internal culture where cooperation was impossible and short-term results mattered more than long-term sustainability. Employees were encouraged to maximize their Enron stock holdings through the company's 401k retirement plan, with executives regularly promising that shares would reach higher and higher values. By 2001, 62% of employee retirement funds were invested in Enron stock, representing their entire life savings. Meanwhile, executives like Lay and Skilling were quietly selling their own shares, with Lay alone collecting over $70 million from stock sales in 2001, while publicly urging employees to buy more. The company's California energy trading desk, led by traders who called themselves the Death Star, deliberately manipulated electricity markets during the 2000 to 2001 California energy crisis, creating artificial shortages that resulted in rolling blackouts and billions in excessive charges to consumers. Audio recordings later revealed traders laughing about stealing money from California and celebrating the financial hardship they caused to millions of families and businesses. Enron's political connections provided crucial protection for their fraudulent operations throughout the 1990s. Kenneth Lay became known as Kenny Boy to George W. Bush, serving as a top advisor on energy policy and contributing over $600,000 to Bush's political campaigns. The company spent millions lobbying for energy deregulation and favorable regulatory treatment, hosting lavish parties for politicians and regulators at Enron Field, the Houston baseball stadium they purchased naming rights for in a $40 million deal. Lay served on the board of the Federal Reserve Bank of Houston and was considered a potential Treasury Secretary candidate. These relationships helped Enron avoid serious regulatory scrutiny, even as red flags mounted throughout the late 1990s. When California's energy crisis reached its peak in 2001, Lay personally met with Vice President Dick Cheney to advocate against price controls that might have limited Enron's market manipulation profits. The company's political influence was so extensive that they helped write the Bush administration's national energy policy, essentially allowing them to regulate themselves while defrauding investors and consumers on a massive scale. The beginning of the end came in August 2001 when Skilling abruptly resigned as CEO, claiming he wanted to spend more time with his family despite having held the position for less than 6 months. Wall Street analysts were puzzled by the sudden departure of Enron's supposed visionary leader, especially since the company was reporting record profits and revenue growth. Lay returned as CEO and tried to reassure investors, but cracks were beginning to show in Enron's financial facade. In October 2001, the company announced a $618 million quarterly loss and revealed that it would reduce shareholder equity by $1.2 billion due to SPE-related transactions. This announcement triggered intense scrutiny from analysts and journalists who began asking detailed questions about Enron's Byzantine financial structure. Bethany McLean of Fortune magazine had published a prescient article in March 2001 titled, "Is Enron Overpriced?" questioning how the company actually made its money. But Wall Street largely ignored her warnings. The October loss announcement could no longer be dismissed, and Enron's stock price began its death spiral from $90 per share to eventual worthlessness. The final collapse occurred with breathtaking speed once investors realized the extent of Enron's deception. In November 2001, the company admitted that it had overstated earnings by nearly $600 million over 4 years and revealed billions in previously hidden debt from special-purpose entities. Credit rating agencies downgraded Enron's bonds to junk status, triggering clauses in SPE agreements that required immediate repayment of billions in loans the company didn't have. A proposed merger with Dynegy fell apart when the buyer discovered even deeper levels of fraud than previously known. On December 2, 2001, Enron filed for bankruptcy, then the largest corporate bankruptcy in American history, with $63 billion in assets that proved largely illusory. The bankruptcy filing revealed that Enron's core pipeline business was profitable but relatively small, generating perhaps $3 billion in annual revenue. The other $70 billion in reported annual revenue came from energy trading operations that were essentially elaborate mechanisms for moving money between Enron and its off-balance sheet entities, creating the illusion of massive business activity where little actual value was created. The aftermath of Enron's collapse reshaped American corporate governance and financial regulation in profound ways that continue today. Arthur Andersen, one of the world's largest accounting firms and Enron's auditor, was convicted of obstruction of justice for shredding thousands of documents related to their client. The conviction effectively destroyed the firm, eliminating 85,000 jobs worldwide and reducing the Big Five accounting firms to 4. Criminal prosecutions resulted in convictions for over 30 Enron executives and employees, including 25-year prison sentences for Lay and Skilling, though Lay died of a heart attack before serving his sentence. Fastow cooperated with prosecutors and received a reduced 10-year sentence. Congress passed the Sarbanes-Oxley Act in 2002, implementing the most sweeping corporate governance reform since the 1930s, requiring CEOs and CFOs to personally certify their company's financial statements and creating new oversight mechanisms for auditors and corporate boards. The legislation costs American companies an estimated $7 billion annually to implement, but is credited with preventing numerous potential accounting frauds. The Enron scandal revealed fundamental weaknesses in American capitalism that extended far beyond one company's criminal behavior. Wall Street analysts who were supposed to provide independent research were compromised by investment banking relationships, with 16 of 17 analysts covering Enron rating it a buy or strong buy, even as the company was collapsing. Credit rating agencies maintained investment-grade ratings on Enron debt until just days before bankruptcy, highlighting their failure as market gatekeepers. The scandal demonstrated how deregulation without proper oversight could enable massive fraud, as Enron exploited gaps between different regulatory agencies to avoid comprehensive supervision. Most tragically, the collapse wiped out over $11 billion in employee retirement funds, with many longtime workers losing their entire life savings while executives walked away with hundreds of millions in stock sales. The Enron name became synonymous with corporate greed and betrayal, serving as a cautionary tale about what happens when financial engineering replaces actual business innovation. Today, the company's headquarters building stands empty in Houston, a concrete monument to the dangers of unchecked corporate ambition and the devastating human cost of financial fraud. The story of Enron reminds us that in business, as in life, if something seems too good to be true, it probably is, and the price of that truth is often paid by those who can least afford it.